Hey, good morning, everybody. Welcome to another Coffee with Kirk. Today, just going to kind of do a hodgepodge, a few questions on some different topics. Thought I'd throw a few slides together addressing those questions. So we'll kind of just jump right in, get into the meat of it. Of course, the biggest question, if you've been paying attention at all this week, or really the past couple of weeks, is pretty decent decline in the markets. So clearly I get a lot of questions on that. So just wanted to take a minute to kind of talk about that. And really this is something I've been addressing for a while. So the real one is some of the kind of higher flyers, the ones we've been talking about that have been carrying the market for years now and gotten to the point where we had a very concentrated allocation to just a handful of names in the S&P 500. So they're the ones that have kind of taken the hit the most. But you can kind of see this just a little Twitter post from Charlie here showing how far off they are. Their 52-week high. A lot of of course, the meme coins or, Bitcoins and Ethereums and all the crypto really have taken a hit. But even, some of the bigger stock names, things like NVIDIA's down 22%, Google's down almost 20%, Tesla's down over 40%. So we've seen quite a big pullback in that, but yet, you look at the S&P 500, it's only down about 5%. So considering those few companies have been such a big part of the S&P 500, to see them take a hit like that might be telling you that maybe we're seeing a shift from those names into, more value-based companies. Otherwise, the S&P 500 would be down substantially too. So, we've talked about all these things. I mean, the market's as expensive as it's ever been. This is just a chart comparing the NASDAQ. So this is just the high flyer and tech names, comparing the NASDAQ to the size of the economy as measured by the GDP. And you can kind of see right now, compared to the GDP, the NASDAQ is more expensive today than it was even in the peak of the dot-com bubble. So, things are priced to perfection. And this, maybe this is just a little pullback. Maybe it's something, bigger. It could be a real bear market. Nobody's going to know until it actually happens. But, things are pretty expensive, even for the S&P 500. We've talked about this, compared to its book value. Book value is basically, really, it's asset base. People use book value to say, would it be cheaper to start a new company or buy a company? That's sort of how book value is used a lot. But compared to the value of the underlying assets, the S&P 500 is at this point more expensive than it was in the year 2000. So again, high valuations. Another valuation measure is the Buffett indicator. So this is how Warren Buffett looks at sort of valuations. And if the overall size of the publicly traded markets in the U.S. are more than the GDP, it starts to become overvalued. And what you can kind of see from this is right now, we're basically two standard deviations, or meaning that we're at the point now where the publicly traded stocks are over 200% relative to the GDP. So it's twice the size of GDP. And remember, for GDP, the publicly traded stocks are only a portion of our gross domestic product. The vast majority of our GDP is driven by small and mid-sized companies. That's really the backbone. So when you see one part of the economy getting valuations that are so much bigger than the GDP overall, you have to kind of take note. So usually Warren likes to see, you see it's somewhere about 50% of the GDP, meaning still valued at half of it. That's where he sees some some real value. So you can see we're at a point now where at an all-time high as far as this Buffett indicator. And speaking of Buffett, if you look at what he's doing right now, he's just raising a ton of cash. In fact, he had his annual Berkshire Hathaway meeting this week, or not the meeting, but released his annual report, which is kind of required reading for a lot of folks on Wall Street. And he really didn't try to address why he's raising this cash. Like, he sort of avoided it. Didn't want to, field any kind of questions or address it in any way. But he has been selling a lot of stock and raising a ton of cash. And then usually when Buffett is raising cash like this, it's because he sees things are just way overvalued. And he waits. He has the ability to sit and wait. Even if he's in cash a little bit longer, and he probably would like to, he sits and waits until things get to be a little bit more reasonably valued. And, everybody knows about Warren Buffett, how he's outperformed the markets. Really, the reason he's outperformed it isn't because his necessarily stock picking is so good. It's more his entry points. So when things are going haywire, that's when he usually has a big, pot of cash, and he puts that to work. So it's just kind of interesting to see him with this much cash right now, all-time high. And then one last measure is, if I haven't beaten this dead horse, but if you compare stocks to just the size of the money supply, so the value of stocks compared to all the money out there, again, we're hitting levels that we haven't seen since the year 2000. So again, all right, so we've got an extremely overvalued market, and we're starting to see things pull back. Does that mean, Katie barred the door, things are going to get really rough? I'm not really sure. Now, if you're looking at crypto, that's really taking a hit here. Crypto, this is Bitcoin compared to the US dollar. You can kind of see it went from about 106,000, I think it peaked at. Right now it's at 84. The chart's actually a couple of days old, but it's about 84.9, something like that, I think. So it's a pretty big drop in a short period. So the thing about valuations is they don't really tell you what's going to happen in the short term, but they give you a pretty good indication of what's going to happen in the medium or long term. So this chart, basically what it kind of shows you is what's the forward price to earnings on the S&P 500, and then what's the subsequent 10-year annualized return. So based on what the forward price to earnings is right now, we're basically looking at something. In the past, when we've had these kind of valuations, the forward 10-year return's been anywhere from like a -2 to a +2%. So all things being equal, if this holds, if you were just to sit in the S&P 500 and not think about it, you'd probably get, a 2% annualized return to even a -2 annualized return. But again, like I said, the valuations don't really tell you anything in the short term. And despite the fear that's been in the markets here the past couple of weeks, it's still basically in a pretty tight range that it's been bouncing back and forth since the election. Since the November election, we've been in a pretty tight range. Now, it's been pretty volatile. You can see from this chart, lots of ups and downs. But for the most part, we're still kind of in that range. We haven't broken through this range. If we break through this range either to the upside or to the downside, then we might have a little bit more actual direction. So for right now, despite the fact I've been talking about how valuations are just ridiculous, right now this could just be some normal market volatility. But what's weird, another thing, this is actually probably a positive for the markets, but even with the markets not that far off all-time highs, the fear and greed index, investors are extremely fearful right now. Maybe it's because they sort of see that things are so overvalued and we haven't really had a good correction really since 2009. Maybe people just think that at some point the trapdoor is going to open up and we're going to drop through it. That could be part of it. But actually, the funny thing is, when there's this much fear in the market, that's often a great time to get into the market. This level of fear, this kind of reading, usually doesn't happen except at market bottoms. Like this is sort of what we saw in 2009 and 2003. This is sort of where you're at. So it's kind of odd that we're not that far off market highs and we're seeing this level of fear. This is like the 7th highest spike in fearfulness, the bearishness, according to the American Association of Individual Investors. That's the AAII. So the percentage of bears right now, it's really high compared to what you'd probably normally think you'd see with the markets at these levels. So it's sort of an anomaly. But the thing you got to remember as an investor, it's the AAII is usually seen as a contrarian indicator. So when bearishness amongst individual investors is really high, that's usually a time to go in. When there's fear out there, that's when you want to buy. But yet you don't usually see it when the markets are doing quite well. Now, this is a pretty busy chart. Again, at the top, it shows you the level of bearishness. But the bottom part of the chart's really what to look at. And really what it's saying is when we've hit these other peaks of bearishness in the AAII indicator, usually, 1 year later, we've had pretty good results. Some of them substantially. When you're coming off of, say, 1990 was a lot of them. After that sort of recession, you're looking at 25% gains. Of course, after March 4th of 2009, when bearishness was at an all-time high, it's never been that high. But a year later, the market's up over 50%. Same with 2022. And then, of course, we had the right after the peak of COVID too. We had extreme bearishness there too. But all the periods after that, 1 year later, even really 6 months later, most of the markets in that period were up. Now, most of those periods that you're looking at here at the bottom were after a recession. So when everyone's bearish and we've seen a big market decline, of course, it's kind of natural to see the market go up at that point. So I know when the market has dropped that the AAII bearish readings are actually a contrarian indicator, and that's when you want to go in. So when we have a market downturn and everybody's bearish, that's when you want to go in. We haven't really seen it that much when, at least at this level, when the market's been doing pretty well. So it's going to be interesting to see. But that is a factor you could say is sort of on the side of the market going back up. The other thing that's kind of in the market's favor right now going up is the fact that the credit spreads haven't really blown out. Usually when we have tough times in the markets, what you see is the spread between treasuries and junk bonds gets pretty wide. So, and that kind of makes sense. If we have uncertainty going on, money's going to run to treasuries, which are a guaranteed payout, and then junk bonds, which are lower quality corporate bonds. People get a little afraid there, so they'll sell those and run to treasuries. But right now, the black line is the difference between the 10-year of high yield and treasuries, 10-year treasuries. And you can see it's really kind of at all-time lows or pretty close to it. If you look at the really big spike there with the black line, that was 08, 09. So you can see at that point, had you bought at the top there, you would have basically gotten 3.5% above what the 10-year Treasury was yielding if you went into junk bonds. Right now, you're not getting even more than 1% above that. So if you're going to go into lower quality companies, could be like GM, Ford, you're going to get maybe half to 0.8% better than you would if you went into a 10-year Treasury. So, usually what you see before, and it usually happens before the stock market feels it, is these credit spreads widen. So the fact that they haven't widened kind of could make you think that, well, what we're experiencing right now in the market is just kind of a correction. It's not really indicative of a bigger long-term drawdown in any way. But we'll see. I mean, this is certainly something I'm watching is the credit spreads. If they start to widen at this point and we have market volatility, that might be a sign things are starting to fall off the track. So the one thing, when the markets are struggling a little bit, and right now this chart basically shows you the free cash flow yield for the stock market overall. And it is right now at its lowest period really since I think the year 2000. So we have struggling cash flow overall in the markets, and we got kind of volatile markets. So what would you want to do? Well, you want to go into companies that are yielding great cash flows. So right now, a good place to go is things that have nice dividend yields, that maybe are paying back quite a bit of debt, maybe buying back stock. So they're really using their cash. They've got ample cash, and they're using it to benefit the shareholder. So we talked about that. Right now, looking at value stocks could be a sign that that's where you want to be. And we talked about this, I think, a month ago or so. But really, ultimately, what is the makeup of a stock investor's return? And there's really three parts of it. First part, you're going to get the dividends. Okay, so that's one part of your return. The next is what the earnings growth end up being. Now, there's all kinds of ways to try to figure out what the earnings growth are going to be. And that's really where the meat of any analysis is trying to get an idea of what the earnings growth is, because that is such a speculative number. You can try to guess, but who knows what's going to happen in the future. And then the last one is the price to earnings, either an expansion or contraction. So you could have no earnings growth, no dividend growth, or no dividends at all. And if the price relative to the earnings goes up, you could still have a positive return. So this is really how you have to focus on it. And we talked about a couple stocks that I'm slowly adding into. This is Permian Resource, so it's an energy stock. But when you look at the stuff and you say, okay, well, right now the current dividend yield's almost 4%. So you're getting 4%. Projected earnings growth close to 5%. So right there, if you can get 9%, even if the price to earnings stays right where it's at. But the price to earnings right now is at a 9, and that's a pretty low, single digit price to earnings. So there is actually potential for that to expand up. But even if it doesn't, what if it just stays at 9? Well, you've got a 9% growth in this company, which is pretty solid. And these numbers aren't too crazy. We're not projecting 25% earnings growth, 5% earnings growth. So with a lot of potential in the price to earnings to expand. And the thing is, if you look at a 9, you probably have a little bit of margin of safety there. I don't think that you're going to see that contract down to 6 or 3 or anything like that. That would be a really screaming good bargain at that point. Another one that we kind of mentioned was Matador Resources. This again is another energy, but this one has a little bit more earnings potential, or at least that's what the markets are projecting. Again, who knows if that's going to happen or not. But when you get a 1.7 dividend yield, if you can get even 15, even 12 on the earnings growth, or even 10. I mean, even 10, that's almost a 12% growth right there with a sub 8 price to earnings. Again, I don't think the price to earnings would go down from here, but it's not that it couldn't, but you seem like there's a little bit of margin of safety on that. So, looking at companies like that. Another one that sort of recently jumped up into my radar, I've watched this, and it's really gone nowhere for years. Molson Coors. So everybody probably heard of Molson and Coors, and they also own Miller. They have a lot of brands in Canada and throughout Europe. So it's a beer company, but beer and alcohol companies have not done very well over the past few years. And this is a 5-year chart, and for the most part, pretty flat. I mean, nothing too crazy. For the most part, stayed in sort of a tight range. So it's just sort of been going sideways, but it's been doing pretty well on evaluations and revenues and things along those lines. Just kind of gives you a breakdown. Right now the trailing price to earnings is 11.4. Price to sales is just over 1. Price to book, it's less than 1. So these are very good numbers here. The profit margin, I mean, that's a little bit low, but you kind of sometimes see that with, bigger companies, within the whole alcohol, drinks, everything like that. You can see that. So it's about 10%, not phenomenal, but steady. And then, the returns on assets and returns on equity are a little bit lower than I'd like, but when you look at the valuation compared to its earnings and price to sales, everything like that, it looks pretty good. And it's not an overly indebted company, 47% debt to equity. So this company's starting to get a little bit of upside. It's when you start to look for things that are a little bit cheaper. The other thing I would like about something like this is typically if we are experiencing the start of a bigger bear market trend, even during market downturns, one area that does pretty well is alcohol. So people, if they're drinking beer, they're going to drink beer, whether it's a good time or bad time in the economy. In fact, you might argue if it's a bad time in the economy, they might drink a little bit more. So that, those are some things you have to really start to look and see. Are we getting companies that have good cash flows? Another thing that's interesting is so far this year, the U.S. is as of this was 2/25, so it's 4 days old. The S&P 500 is pretty flat. It's up 1.4, but a lot of international markets are crushing it so far this year. And this is just year to date. And I've talked about this for really the past 2 years, just how when you look at valuation metrics, international stocks have been left for dead. They're much, much cheaper than U.S. stocks when you look at everything from price to sales, price to earnings, everything like that. It's been much, much cheaper. And we do have periods, extended periods, where for 10 or 15 years, U.S. might outperform international, and then you have it flip and international outperforms the U.S. Now, I don't know if we're seeing a change in leadership in this, but at least this year it's certainly happening. And the thing is, since 2009, the U.S. has dominated international. So we're basically just past that 15-year mark, which is a long period of outperformance for the U.S. So maybe we're at a point where the valuations are so high on U.S. stocks that money's going to run to things that have a little bit better price to earnings. Now, it doesn't mean that international markets are more dynamic, that they're in any way better than the U.S. economy, and they're not. They don't have as many innovative companies. They don't have the resilient economy that we do. It's just it comes down to valuation. Actual earnings from these companies internationally, you're just paying less as an investor to get those cash flows. So it's not that even the growth in the international market's better. It's just the value is better. You're getting, it's like shopping at Aldi versus going to, a higher end grocer like Whole Markets or something like that. You buy a gallon of milk in Aldi, you're probably going to pay $1 less than you are if you go to Whole Foods. And you could stay with that example. Maybe the Whole Foods is a little bit better quality, but if you're looking at the quantity of milk that you're purchasing, you're probably better going to an Aldi. That's sort of what we're looking at with international. So that could be a trend that we're seeing here. But again, only time will tell. So another question I get a lot now for Tesla. Tesla's down over 40% from its peak. So everyone's like, we want to go back into Tesla? Now, I guess it was a month ago, I looked at Tesla a little bit along with the other Mag 7 stocks and tried to show you the valuations. I mean, Tesla has been a sexy story for a long time, but it's, I keep thinking of that little old lady from the Wendy's commercials in the 80s. Where's the beef? When are we going to get those earnings to really match the valuation, the price of the stock? So things are down 40%. Maybe they'll go back up if you bought here, and if it goes back up to its all-time high, you've just made 40%. That's awfully good. But I don't know if I'd go into this. This was a chart I showed you a couple Coffee with Kirks ago, just showing you that even from when Trump won, so this was in November, we had an absolute skyrocket of the price of Tesla, went up almost 60%. But when you started to, and they're trying to say, oh, we're expecting 31% growth rate, everything like that, they had just the rosiest numbers on Tesla. But really, when you get into it and you start to look at Tesla's numbers, they're just not there. This is a breakdown of their profits. So first thing you notice is from, this is only 2 years, but really not, you'd want to see something that's valued like Tesla straight up to the right. None of this stuff. You want to see growth every single quarter that's going up. And what's even more interesting is this breaks it down. If you look at the profits they made in the last quarter of 2024, not a whole lot of it came from their automotive sector. A lot of it was non-operating profits. So non-operating profits, the biggest part there was they had actually made an investment in Bitcoin, and the Bitcoin did extremely well for that quarter. That's the purple there. So, they're really not growing all that much. For 2024, the stock was up 63%. But what was the revenue? It was up 1%. That's not a rocket ship of growth by any stretch of the imagination. So this stock has just been going crazy, mostly because Elon was the CEO. It's a great story. And it's not that it's not a great company. It's not that the cars aren't great. You come back to what are you paying as an investor for their earnings? That's what it's all about. This is another chart I showed you a little while ago. Very busy chart. So if you watch the replay, you can pause it here if you want to really dig into the numbers. But the big thing is, what I'm trying to show you here is you look at the chart in the middle. So revenue, the little green chart, it's flat. You're not getting massive revenue growth. The earnings before interest, taxes, depreciation, and amortization. So this is kind of what they call fake earnings. If you're Charlie Munger, you pull a lot of things out, but that's actually in a downward slide. And then net income, the actual profits, the bottom part in blue, that is also sliding downward. So how is this company getting more and more investment when really the numbers aren't growing anywhere near to justify what's happening there? So I'd be very weary if you're thinking of jumping into Tesla because it's down 40%. This was a chart I showed again a couple weeks back, and using that metric, we don't have any dividends. If you project the 23% earnings growth, which based on the last chart, we're not getting 23% earnings growth. We're really kind of flatlining. But let's say, okay, 23%. So just based on dividends, earnings growth, you say, yeah, stock could grow 23%. But it's at price to earnings. So it was at 196. So even if it pulled back 40% from there, you're still looking at about 120 price to earnings. So even where it's come back now, 43%, you're still looking at a price to earnings of about 120. That means it's still radically overvalued, especially if it's not getting that 23% in earnings growth. So I'd probably steer clear of Tesla, if you ask me. Okay, another question. So housing. I probably should do a big deep dive just on housing, but I get questions time to time. It's a good time to buy a house. Should I buy a vacation home? What should we do here? Well, housing also has some headwinds in my mind right now. Of course, housing is always a local thing. I think if you're in the Northeast, some parts of the Mid-Atlantic, it's probably okay to buy. There's a very low supply of homes, so those prices are probably going to stay pretty stable unless you're in probably the Washington, D.C. area. That's starting to have some issues. But some of the areas, Florida is an area, some of them that have had rapid growth, kind of the same areas that have had it back with the last housing bust: Florida, Vegas, Arizona, California. Some of those areas are going to experience some issues. They're starting to see more supply come on the market. Now, California is a little bit odd because of the fires in LA. Sad to say, it probably is sort of good for people who are selling their house everywhere from probably north of LA to down to San Diego. But right now housing is really expensive. People are spending about 40% of their household income on housing right now, whereas the historical average is about 30. So, when you're spending more and more of your budget on housing, that starts to have an effect on the overall economy, because that's just that much less you can put into the rest of the economy, other things. And we're also starting to see mortgage delinquencies. The Freddie Mac serious delinquency rates are now above where they were at the peak of the housing bust back in 2009, 2010. Now, it hasn't been that big of a news story because last year, the Biden administration actually had given Freddie Mac, I think it's $155 billion, to basically pay the mortgage service originators to not foreclose on homes that were seriously delinquent. So there's been sort of an overhang. They just kind of kicked the can down the road a little bit, but these delinquencies are going up. And again, you don't hear about it because the foreclosures haven't happened yet. I don't know if they'll continue to fund Freddie Mac to pay off the folks actually operating the mortgages or not. I don't know. We'll see. But if not, you could start to see foreclosures pick up. And the thing is, pending sales are just, they're rock bottom. They're even below the bottom of the last housing bubble. So just no activity going on in housing whatsoever. And then the new home inventory, so this is builders inventory, it's now awfully high. It's not what it was at the peak of the housing bust back in 2008, but it's still awfully high. It's in a range that we usually only see during recessions. So we'll see if that plays out. And then, of course, people just aren't looking to buy right now. As far as buyer sentiment, nobody's looking to buy. So when you have that, now you might say, contrarian would say, okay, well, if nobody's buying, it's a good time to be a buyer. That might be it. But it seems like there's some headwinds there that I think if you're looking to buy a second home, a vacation home, it might be a good time to wait a little bit. you might start to see prices start to come back a little bit here as reality sets in. If we start to see some foreclosures, if the extra inventory in some of these vacation areas, if it continues to see more and more homes come on the market, you're going to see some downward pressure on prices. So that could be the time to look to really get into it. Now, mortgage rates have come down a little bit here the past couple of weeks. So that could be a good thing a little bit for housing. It's a little bit less expensive. I think we're now down to roughly 6.8 on mortgages, maybe 6.7. I didn't check yesterday. But still, that's much higher than what we've had just even 5 years ago. And with the sentiment being so low for home buyership, it's not a few basis points down from the peak is not going to draw in a lot of investors. But, the thing is, rates could come down even further. This is just a chart showing the 20-year Treasury bond ETF and the amount of short interest. So everybody's betting against bonds right now. Usually when, again, contrarian, when everybody's betting against it, you typically get the opposite. So maybe rates will come down substantially from here. That could be a good thing for housing. Time will tell, but I still think for the most part, unless you're in areas that have really, really low supply, like the Northeast and parts of the Mid-Atlantic, and some parts of the Midwest, you're probably going to see a little bit of a pullback in prices. Okay, another question that I got. So last presentation, a lot on gold. So somebody said, well, what could gold go to? And nobody knows. But I heard just recently a really good interview with financial analyst Luke Groman. And he was talking about how he looks at the potential price for gold. And what he tracks is the total value of the U.S. government's gold holdings as a percentage of foreign-owned treasuries. Not domestic-owned treasuries, but foreign-owned. And the reason he looks at foreign-owned is because his theory is the government doesn't have a problem underpricing bonds for domestic owners, so for its citizens and internal mutual funds and that, because they'll just inflate they'll inflate that away. And they won't really care because we're citizens of the U.S. But if they try to do that to foreign owners of treasuries, they try to inflate that away, well, all these foreign governments aren't going to put their money into treasuries if that's the case. So they have to keep it kind of honest, if you will. They have to make sure that they have the reserves in gold to match the treasury, foreign-owned treasuries. And what he said is if you go all the way back to 1950, the average is about 40%. So we have about 40% of our gold relative to the percentage of foreign-owned treasuries. Okay. In 1989, it had gotten down to about 20%. And then in 1979, it was 135%. So we had tons of gold relative to the percentage of foreign-owned treasuries. And his thing is, back in 1979, gold was a bubble. 135 is way above that 40%. So that just tells you that gold was extremely overvalued at that point. And it was. It did. It pulled back massively. Went from 850 all the way down to like 200. So that's a pretty big pullback. But in 1989, if you'd have jumped back into gold at that point, it was a pretty good deal. You were paying probably still around 200 an ounce, maybe 220 an ounce in 1989. Well, what is it today? Well, today it's about 9%. So it's really, relative to the amount of foreign-owned treasuries, it's really undervalued. So if the foreign-owned treasuries stayed static, if the percentage of that, the amount of that stayed static, you could expect gold to rise to get back to that 40%. You're looking at 2 to 4 times increase in the price of gold. Now, that doesn't mean that's going to happen right now. You can see the numbers we're using here, 1950, 89, 79. I mean, we're talking decade here. But that sort of tells you the price of gold is cheap if you look at it on a historical basis. And I showed this chart last Coffee with Kirk, just showing you that relative to money supply, gold's finally having a good solid move up, and it could break a longer term trend here, which could then, see the price of gold go up substantially. If it holds, it could always pull back from this point. But, based on the other metric I just showed you, you could have a good argument gold's a good place to be. And of course, I get questions, if gold's a good place to be, well, what about the gold miners? And it's an interesting thing. So miners are extremely, extremely volatile, but they tend to move, because of the volatility, a lot more than the price of gold. So if you can get it at the right price, the miners, you can get a very substantial move one way or another. Now, a lot of times that can be the wrong way, but sometimes if it's undervalued relative to the price of gold, it can move pretty fast. And what's interesting, it seems like, all of these Wall Street beats and all these things on Reddit, they're starting to look at miners. And not that that means anything as far as actual analysis or valuation. I mean, these guys are just speculators. These are the ones that pushed AMC theaters way up. They're the ones, that pushed all these meme stocks to extreme heights, Bed Bath & Beyond at one point. But what was the other one that really went nuts? But Peloton, all these that went crazy, but this was people just piled in. And now they're starting to look at the miners. Here's another little post from somebody talking about that again, saying kind of it's been left for dead. So a lot of these speculators might be jumping into the miners. That's not really a reason you'd want to get in, because that would just make it completely detached from fundamentals and become even more volatile, but it could be a tailwind, honestly. Now, the big thing is, well, actually, this is a chart for the past 5 years, and you can kind of see what the price of gold in dark blue, silver in orange, and then the miners are in, I don't know what that is, turquoise, I guess. But anyway, if you look at the main number over the 5 years, miners have trailed the precious metals by 50% over the past 5 years. So, could make an argument that just based on the price of the physical bullion, miners could offer compelling opportunity here. And this is a chart that shows you the price of gold bullion relative to the 8 Hui ratio, which is basically a conglomerate of miners. And you can kind of see the price of gold is substantially stronger than the Hui index. So again, when you're talking miners, you have to get into all of the different parameters that any publicly traded company has. Just because the price of the product's going up doesn't mean that the company that's mining it is actually well run. It could be a horribly run company, so you're not going to get the same benefit. Also, a lot of mining is done in political areas that aren't real stable, so that can always change things too. But if you just start to look at it, again, the miners to gold ratio, at some point you'd think that you'd start to see a move up in this, but so far the price of the bullion's been going very well, whereas the miners have been lagging. And then the thing is, some of these companies are generating phenomenal cash flows. This is a Newmont corporation, and right now its dividend yields, 4.5%. So a company usually doesn't set a dividend yield like this unless they know they have the cash flows to cover it. So again, going back to our analysis, even right there, 4.5% yield, and their underlying product, gold and silver, are doing very well. So whatever they pull out of the ground, they're going to be making a nice profit on it. Right now, they say it's about the cost to pull gold out of the ground is about $1,550. I think that's the last I saw. And if it's still priced at $3,000, that's a pretty darn good profit margin. Okay, so those are some of the questions I had. As always, I show the disclaimer there. But yeah, a few of the questions I got, obviously the market turmoil that's been going on is a big one. Gold miners. Should I get back into Tesla? Everybody wants to jump back into Tesla. So let's see, what do we got for some questionable car prices and gas start going up. So the car market is an interesting one. It's actually kind of struggling. I think car prices could come down a little bit. There's a lot of backup in cars. So a lot of people are trying to say that sort of leads to possibly some recessionary, but you're starting to see that auto manufacturers pull back on manufacturing all over the place. Volkswagen and Mercedes-Benz actually trying to cut 20% of the workforce, which they usually don't do in Germany, but I think they're going to be able to do that. So there's a lot of cars in the market. Who is it that owns Stellus, owns Jeep and all that? They're really backed up. So I think there's a glut of cars, at least everybody I've been following. So if you are looking to buy a car, I'd probably give it, maybe 6 months or something if you can. I mean, obviously, if your car goes kaput, you got to buy. But if you could stretch out your car for a little while, I think you're going to start to see some pretty good prices. You can still, right now, get some pretty good. There's a lot of incentives. They're back to 0% financing on new cars and some rebates. So they're doing what they can to move it. But it's, from what I've been reading, it could be a good time to buy a car in a few months. As far as gas, that one, I wouldn't tie that in with the car price per se. So right now we've kept in a range on oil anywhere from 75 to 90, and it's been that way for a long time. So if we stay within that range, I'd expect to see, anywhere from 280 to 330 a gallon, depending on what state you're in and what kind of taxes you're looking at. I don't know if we'll see a big move up on that. Honestly, I think we've been range bound for so long. It's going to take a big factor one way or another. So if we'd have to have a real shock to supply for it to go above 90. And we'd have to have really a pretty strong recession to see it drop below that 70, 75 range. So outside of a big event, I think we're going to be somewhere in that 75 to 90 range for a while. But if you can buy, energy companies that are making good money within that range and paying out nice dividends, that's what you want to kind of look for. Because oil and energy companies are pretty cheap historically relative to their historical valuations. Are you staying in TLT? Some of it, yeah. It seems like bond yields have been coming down. That could just be a factor of the stock market experiencing some rough times. So, if stocks turn back up and go, maybe that point, go back to shorter term bonds and stick with that. But for right now, kind of stay put and see what happens. I might actually add a little bit more to some longer dated stuff, but we'll see what the stock market does here. So if the stock market continues to go down, this was the first time in a while we've had that seesaw relationship between stocks and bonds. Really since 22, we've had bonds and stocks go down, and then bonds have just struggled overall really since 2022. This is the first time we had, people sold stocks and ran to bonds. So I think that's the relationship we're looking at right now. And if stocks continue to struggle, we'll probably see longer dated bonds do better. But yeah, and if stocks regroup and head back up, we'll probably see bonds give back some of the recent gains they've had. So we'll see. I think we could be just seeing a shift to more value play, because the stocks that have taken it on the chin were higher flying companies, but yet the market's not drastically down. which tells me money's running to other parts of the market, more value plays. Companies that are better dividend yields, better cash flows. I showed the international better valuation, so we'll see. Okay, I guess that's all we've got. I hope everybody has a great weekend, and we'll talk to you all soon. Take care, everybody.